There are signs of a global recession visible in the stock market. Now, with the uncertainty in the Middle East that is affecting Wall Street fundamentals, are we going to experience another stock market crash? Whether yes or no is not the most important thing. But the most important thing here is, will you be safe if there is a global recession today? Welcome to Clockwise. My name is Providence, and today we'll be discussing 4 stocks you need to get now to protect your portfolio. Even if we have a global recession, you will be safe. And you know how we do it? We bring a stock analyst, one that sleeps on the charts and look at the fundamentals on a daily basis. I'm talking about a stock market analyst and researcher, and also a clockwise researcher. Please welcome Mr. Kandem. Welcome to Clockwise again.
Thank you very much for having me. Thank you to the audience.
Yeah, it's a very nice or beautiful pleasure seeing you again.
Thank you very much.
I can remember the last conversation we had, and you actually brought out pointers that shows that we are about to enter another recession. And that was some few days ago. Now, I want to ask you again, are you still standing on those ideas? Are there changes in the market?
So, for example, before we got onto the studio, I told you that my thesis was this. If the disruption in the Strait of Hormuz stay till the end of March 2026, there is more than an 80% chance that we're going to slide into a global recession. And the reason is very mathematical. The Strait of Hormuz controls 20% of the global petroleum oil supply. It also controls another 20% of LNG. These are core to industrial production across the world, in the manufacturing processes and all of that. So if you lose that, you have slowed down production by a very long shot. That's number one. And also, don't forget that that particular strait also controls a huge chunk of the fertilizer supply that goes out. So that means it affects not just energy, it also affects fertilizer and by extension agriculture. So these are the ingredients that you really need for a global recession. Once that happens, once the energy prices soar, this morning we saw 120 on Brent, though West Texas Intermediate is still around 98 because of the fact that it's basically US oil, and US is somewhat self-sufficient. But we're looking at Brent, the international benchmark. Brent is 120. If you keep Brent at 120 for a long time, then it's most likely going to result in hyperinflation. And the only way the Fed, the central banks around the world, the Fed, the ECB will respond is to increase interest rates. Yesterday was an interest rate decision for the month of March. And what happened? The Fed decided to hold rates steady. And even in the speech by the Jerome Powell after the rate decision, he still said that the Fed is so bullish on ensuring that inflation expectations are well anchored.
Okay.
So what does that mean? It means that the Fed, in fact, if you look at Polymarket and Kalshi, those prediction platforms, you realize that the odds of a 2 rate cuts this year has almost gone to less than 30% now. And the odds of even a rate cut later this year is quite low now. So what that means is that, in fact, a rate hike is even on the table now.
Okay.
So if the Federal Reserve or the central banks start hiking interest rates, what that will mean is that access to capital will be more expensive, and so you will have a very serious production.
Okay.
Do
we see an end to this uncertainty? Do we see an end to it? Is there an end very soon?
So here is the deal. Yesterday, the NATO countries, a lot of them actually pulled out of supporting the US to reopen the Strait of Hormuz. It is infeasible for you to be honest with you. It is infeasible for you to think of having fighter jets, or yes, you might have a superiority over the Strait of Hormuz, but it is infeasible for you to have warships, escort vessels. It is economically infeasible because of the expenditure involved. Companies, insurance companies are not willing to take on that risk. If anything happens, you're talking about hundreds of millions or even billions of dollars in damage. Insurance companies are not willing whatsoever to take on those kind of risks.
So there's no end to it?
So at this point, there are a lot of things on the table, but in all of this, one of which is what I talked about in the last podcast, in the last edition of the podcast. I said, can you put foot on the ground? That would lead to a lot of American casualties. And this is midterm election year. It will be very, very disadvantageous to the ruling party for Donald Trump to think of putting foot on the ground. Even if you decide to take the U.S. warship to the Strait of Hormuz. Now, remember, this place is like 30-something kilometers from the nearest land. Meaning that these guys can literally fire. And what they are now doing now is they are firing, like, they could fire like lots and lots of missiles at the same time, making it difficult for your interceptors to be able to work effectively. You just need one or two of those missiles to go through, and then you cause a very intensive damage. Damage not just to a warship that is worth billions of dollars, but also damage to, you are looking at the human lives that will be involved. And the US is very intolerant to losses, those kind of losses, especially human lives. So by looking at it politically, this is an election year, a midterm election year. It is not likely that the US would want to put boots on the ground. Neither would they want to have their warship going there. So that means that, and the fact that the NATO countries are pulling out of the support means that the conflict we have, the gridlock that we have on the Strait of Hormuz might last for a long time. And remember, I told you the last podcast that once the supply that left before the start of the conflict is exhausted, then what you would have is that people will now begin to feel the brunt of the crisis in Hormuz. Now, you talked about some people are. Someone asked me yesterday. Of course, there is a pipeline from Saudi Arabia that leads, but that pipeline is not even doing up to half
of what moves. I think the quantity that moves through the Strait of Hormuz is actually the advantage.
Yes, it's the quantity that moves through the Strait of Hormuz. That's one. Number two, well, are you going to move fertilizers through the pipelines?
Okay.
Are you going to move gas? Those pipelines are not specifically, so you can do petroleum product like crude oil, but there are a few other things that actually depend on that movement, that traffic and the Strait of Hormuz to really move. But if those things are not settled, then you are most likely going to have a global recession.
All right.
And you can see it already on the charts.
Yeah. All right. First of all, we had something like this in 1982. Then we now had another one in 1991. Then I could remember the one of 2009. That was caused by, the housing bubble bust of the United States in 2008. And then the COVID pandemic in 2020. Now, if we have a recession now, how bad will it go?
Okay. So here is the deal. If we have a recession now, so there are a lot of things that come into the mix. I want to first of all start by saying that 4 out of the 5 recessions from 1980 were actually oil shortage actually caused 4 out of the 5.
Yeah, 4 out of the 5.
Yes, 5 recessions.
Apart from the 2009.
Good. So here is the deal. How bad can it go? We cannot tell, because there are a lot of things that come into the mix. How soon will the Strait of Hormuz be
because
open?
that's my question, because it's not a policy problem. This is not a policy problem. The recession will not be caused by a policy problem.
Yes.
It's actually true by, should I say, a conflict.
Yes.
Wars. Now, how bad will it go if there's a recession now?
The thing is this. At what point would the USA declare victory?
Okay.
at what point, like I said in the last podcast, that there is a problem here. If Donald Trump says, okay, Iran, here is the deal, let's come to the table, let's negotiate. You guys will allow reopen the Strait of Hormuz. Actually, I use that word reopen in a figurative sense, because in reality, it's not as though they are putting mines or anything there.
It's not close.
But just a threat that if you guys pass through, we will deal with you, is actually what's making the Strait of Hormuz to be essentially closed. So, but if Donald Trump says, if the Trump administration says, you know what, come to the table, let's have a negotiation, I am very certain that the Iranians, they are basically fighting some. The IRGC, that is the Iranian government now. That regime is fighting for survival, and so they are most likely going to give conditions that the US might not want. For example, they could tell the US, listen, we want you to be out of the Gulf states.
And that would be somehow.
And you understand that. So that would be something that the US might not want to go to. Because going that route would really mean that you have literally surrendered. That's one. That way, that could actually reopen the whole Strait of Hormuz. That's number one. Number two is putting foot on the ground. If you put boots on the ground, then there's a very high chance that you can actually gain not just air superiority, but ground superiority too. But that would lead to insane amount of casualties. You will have many American soldiers coming back in body bags. Yeah. That would be very terrible for the Trump administration, especially because this is midterm election year. So I would tell you that Donald Trump is in between a rock and a hard place. Any decision that you take, Donald Trump would not want to live with his tail between his legs. No, he won't. That's number one. Number two, especially when he has already said that he told I think the UK Prime Minister, I think the UK Prime Minister eventually agreed to send the UK warship, and he said, we don't need you guys anymore. The war is literally over. If you say the war is over, then the war has to be over. You cannot chicken out. You can't possibly chicken out simply because you need the Strait of Hormuz to be reopened. That's number one. Number two, you cannot also have boots on the ground and incur such casualty in an immediate midterm election year. No, you can't do that, because if you do that, it will hurt the performance of your party at the midterm elections, especially because the US, only 6 soldiers that have lost. You can see the kind of people are literally losing their minds. Yes, he still has, the MAGA base still believes that he is doing a good job, but it's not the MAGA base alone that will vote during the midterm election. So these are some of the tough decisions he has to make, and happily or fortunately for him, for Donald Trump, the Gulf states are now kind of siding with the US government, because Iran is literally attacking the Gulf states. So Iran is almost like prosecuting this war alone. So let's see we just want to see what happens, what the Gulf states can really pull, if they pull themselves together, what kind of influence can they make to further decimate the current regime in Iran.
All right, now this if there's a recession now, I'll still hammer on that, because we're actually speculating. If there's a recession now, what areas do you think will be badly affected? Because it will be caused majorly by oil, by energy. So
if there's a recession, of course, traditionally, number one, you want to avoid high growth stocks.
Okay.
If there's a recession, you are going to have tall inventory. Recession, people will not, purchasing power gets decimated. Discretionary, consumer discretionaries will be hardest hit. So you want to avoid those areas. Growth names, companies will not be, investors will be more about capital preservation rather than capital appreciation. So that will mean growth will actually stall.
Okay.
If growth stalls, that means growth stocks will be seriously hit. Then you are looking at airline and travel. Of course, during recession, who has the you are, everybody tries to, conserve the little they have to be able to afford healthcare, food, shelter, and all of that. Nobody has time. Travel is more like discretionary at that time. So you want to avoid airline stocks, really. Tourism, travel companies, and all of those. Those stocks you should.
What of mineral stocks? Will it actually affect it, like say gold and the rest of them?
Gold actually performs well during recession. For very obvious reason, because during recession, what do investors do? Investors run to safety, and gold has traditionally provided those kind of safety. I know, speaking of gold, you will say, what about Bitcoin, which is being touted as digital gold? The reality is that investors are still treating Bitcoin as a high beta tech stock. High beta means that gains in tech stocks get amplified by Bitcoin, and losses in tech stock get amplified by Bitcoin. So because of the way investors are considering gold, or Bitcoin, that is the reason why, if you observe, Bitcoin trades more like Nasdaq in recessions, rather than trading like gold. We saw what happened recently. So what you see in 2020, for instance, Bitcoin went as low as $3,200. Because recession, Bitcoin was traded more like a risk-on asset. Now, but of course, when there was a reversal, when you had the largest injection of money into supply, Bitcoin from 3,200 in 2020, Bitcoin topped out at $69,000 1 year later. Think about that for a second. 1 year later. 2021, Bitcoin topped out at 69,000. You can do the math. That's like 13. Did I say that's like 23 times, about 23 times return on within 1 year. So the reality is that you want to look at gold as what we call, number one, inflation hedge, number two, a safe haven asset where investors
is it a better time to buy gold now?
At this point, I would say, speaking from what I see in the chat, gold is actually correcting. Gold has done a very serious run-up. It's an insane run-up. Gold literally did over 70% year-to-date before all of this happened. So you want to look at, it's cooling off at this point. People are like taking profits. People are rotating into some other sectors, especially oil, because oil is now like the best thing since sliced bread. So people are rotating from gold to oil. That's why you have it. If you look at contracts for gold before, as at first week of February, was around 300,000. But now, as I speak with you, it's above 1 million, for gold. So what that tells you is that people are like literally rotating out for oil. I mean to say some. So sorry. For oil, contracts for oil, oil futures contracts was trading around 300,000 per day. Now it's above 1 million. Okay. So meaning that people are rotating from gold to oil and some other assets into oil. And you've seen even the S&P 500 is now down 6% from its all-time
But this is actually panic buying and also panic selling. It's not actually based on fundamentals. People are just...
Like I told you, you have to prepare for market dislocation. It happens every single time. That's why I said in the last podcast, I said, what did I say? I said, you might want to have some cash on the sidelines. Because you might want to rotate into some names that will be resilient in the event that we have a recession. Those names, you have to be very cautious. You have to have cash on the sidelines. If you don't have, people that cry during recession are people that are already invested, literally 100% invested in like high growth stocks that are hardest hit during recessions. So when a recession comes in, they see their portfolio melt away, and they don't have cash on the sidelines to take advantage of those discounts. So that is why we say you cannot afford to be fully invested at this time. You should have some cash on the sidelines that you can take advantage of a recession if it shows up.
Okay. All right. Now, from my studies about recession, I realized that it actually does two things. It can actually kick you out of the market, and to some other people, it's an opportunity to actually create generational wealth.
Yes.
And these are people that have foresight to how things will actually unfold as we go. Now, on today's show, I'd like us to dwell on those particular sectors. Those sectors that will be they're like gold mine when it comes to recession. They are like defensive stocks that can protect your portfolio. What are those stocks you actually advise people to actually have take position on now before recession?
Okay, so let me start by saying this. When you talk about recession, you have to look at the context of that recession. The recession that we believe might happen here, or we are inclined to believe might happen here, would be an oil shortage recession, based recession, or an oil shortage triggered recession.
Yes.
Meaning that you are looking at oil staying above $100 per barrel for a long time. Obviously, you will know that oil stocks will do very well. Very well. The only thing is that one has to be very careful. That's why I'm saying I know a lot of people that are going to YOLO into
oil stocks
at this point. Some people have been calling me, what are some Nigerian names I can go into, and all that. But I tell them, listen, and some of them are even really I'm saying
we've not actually seen the effects.
I'm saying that oil is doing literally doing a gallopy kind of growth every single day. Oil prices. Yeah. So you don't want to go into oil completely, because if the Strait of Hormuz opens suddenly, you can have a sharp correction. Remember when the Monday of last week, Monday of last week, oil futures jumped to $125 and corrected sharply to 78. That's a kind of correction that you'll have if the Strait of Hormuz is open. Now we are sitting around 120. It is possible, if it continues to persevere, we can see $150 oil. So you might see that $150 per barrel oil. But I want to let you know that if the Strait of Hormuz opens, that could correct to less than $100 in less than 2 or 3 trading days.
That would be a very big loss.
That would be a very sharp correction. And the reason is that as people try to close their positions, there's a cascading effect. People get liquidated, and you have those massive liquidations that keep on taking prices down, especially because most of these contracts are being serviced by margin debt. People borrow to actually buy into this.
All right, now I want you to give us a list of the companies you are taking position in now, the companies you're going to buy. Now, we are not saying people should actually buy them, but based on your analysis as a stock market analyst, what are those companies? List them, like 4.
Okay, so I'm going to speak in terms of sectors. I'm looking at Chevron.
Okay,
one. Looking at within the energy sector, I'm looking at Chevron.
Okay, one.
I'm looking at ExxonMobil.
Okay, you've given reasons already, yes.
I'm looking at ConocoPhillips.
Okay.
Yes, these are US-based oil companies. In Nigeria, I'm looking at Seplat, but there are a few things I'm going to have to look out for before I really...
Things like what?
I want to look out for... Seplat has been... I want to see some correction so I can actually get a good entry. Then that is for energy sector. Then I've seen a decent correction in Lockheed Martin.
Okay.
Yes, and I'm looking at getting a position in Lockheed Martin. Okay. Re-entering. I'm looking at reallocating to Lockheed Martin, and the reason is because if this conflict persists, the US would need to refuel, and that is billions of dollars in contracts for Lockheed Martin. Not just Lockheed Martin. I'm looking at Northrop Grumman. To also gain a position in there. I'm looking at RTX too. But of all these 3, I'm most likely inclined to do Lockheed Martin and Northrop Grumman. So then that's for defense stocks. I'm also looking at healthcare. Because healthcare for me, I'm looking for healthcare. I'm actually looking at Johnson and Johnson, and I'm looking at United Health. Why am I looking at Johnson and Johnson? Because it's also a dividend stock, dividends paying stock. In a recession, like I said, one thing you must note is that you are not just looking at capital preservation. Capital appreciation. You're looking at capital preservation. So definitely portfolios will go down. But at least if you have something, one of the things that help people not to have to sell in the event of a recession, because in a recession, there's a possibility you could lose your job. So if you lose your job, guess what? The next thing you would do is to look for portfolio for some assets to sell, and you'll be selling these assets. Then you'll literally be buying high and selling low. You'll be selling these assets at a price that you should not sell. So, but if you have a dividend stock portfolio, that means you have some cash flow that will help you to sit through the recession and possibly buy more. Let's say you have some dividend payments, you can be looking to buy to take advantage of the downturn. I had said earlier that for the ultra wealthy and the wealthy people, they plan for recession over 10 years. Recession is actually something they plan
for.
If we have a recession this year, then we would have had one recession with 2 recessions in 2 decades, in 1 decade. We had one in 2020, and then we're having one. Okay, if you look at 2020 as part of the other decade, then maybe you could say, but I mean, we had one in 2009. Then we had one in 2020. Okay, so I mean, we'll have one. Like I said, the strategy is for you to look out for recessions, and these are generational buying opportunities. So if you have a dividend stock portfolio, one of the things we should know, dividend stock portfolio might not appreciate as much as growth stocks, but they give you that cash flow. And that cash flow could be something you could use to gain access to positions or to assets when they are on sale. For those people that lean towards growth stocks, you might experience a sharp correction in your portfolio. But what you could do is this: you could still take advantage of the ensuing recession, if indeed we get into a recession, by doing what I had talked about in the last podcast, in a few podcasts before now. I talked about the buy, borrow, die strategy. So, but for that, let's say your portfolio is, you might want to do maybe 10% of your portfolio. You might take a loan and like just 10% of your portfolio. Let's say your portfolio is like $100,000. I don't advise you to take up to $40,000 because you might have a correction as sharp as 40-50%, which would take your portfolio down to 50,000. And there's something we call, you don't want to receive a margin call, neither do you want to be liquidated. So 10%, 10-20%. I'm not sure we might have as sharp as an 80% correction, especially on the S&P 500. I'm not sure we're going to have that. So a 10 to 20% loan against, that's what we call margin debt, loan against your portfolio, might allow you to have some dry powder. That is if you are fully allocated to growth stocks like the Mark 7. It might not be such a good time for you to sell, to have some dry powder to take advantage of the recession. So rather what you could do would be to borrow against that. But you have to be very careful. Like I said, 10% of your 10% is a good point. Borrow like 10% and then invest. Because traditionally or typically what happens is after a recession, of course, the Fed will react by injecting more liquidity into the system. You always have a very serious rally. And so you can take advantage of that rally. Could even multiply some of the gains that you multiply your gains. But you have to be very careful not to be greedy enough to go and borrow overexpose yourself to loans, because if you borrow too high, then you have a correction, a very sharp correction. Let's say this issue escalates even further. For example, let's say people begin to sympathize with Iran, and then come in, some powers begin to sympathize with Iran and then come in to assist. Then a sharp correction could maybe take you close to margin call.
Okay.
And when people get to margin call, when you get a margin call, sometimes you can make irrational decisions. I don't advise you to do that. I'm just saying it. And by the way, everything I'm saying here is none of them is financial advice, not tax advice, not legal advice. You might, it's just what I'm thinking, what I'm doing myself. So, but though for me, I rather have something on the sidelines than really going on margin debt. Do I have some margin debt? Yes, I do. But it's very curtailed. It's like 5%.
Okay.
So, but if you do 10%, 10% means that whatever the correction is, you need about 80-something% correction for you to be liquidated.
Okay.
So you do that, then get a position when the market goes down.
Which other last stocks? You've mentioned 3 sectors.
So I've mentioned healthcare, I've mentioned defense, I've mentioned oil. Then I cannot fail to mention defensives. Defensives like Coca-Cola.
These are beverage.
Yes, it's a beverage. Like Coca-Cola. Coca-Cola is a defensive stock.
Not defense, defensive.
Then you are also looking at staples, consumer staples. Coca-Cola, for example, is a dividend stock portfolio too. So you might want to look out for defensives that not only survive during recession, but also pay out dividends. Okay. Like I said, you need cash during recession. You need cash flow. It's very important that you need cash flow. So defensive stocks that are dividend paying stocks. That's something you need in your portfolio. Then you may also need to invest in gold. So gold, how do you get exposure to gold? You can get exposure to gold through like Newmont, which is a gold mining company, or you can gain exposure to SPDR, which is a gold-based ETF.
Yeah.
So ETFs, of course, we have talked on this channel. By now, people on this channel should know what an ETF, an exchange-traded fund. So that allows you to track, rather than you having to pick and choose. You can actually track the performance of a particular asset. So you can do a gold ETF. You can invest in miners. Miners make a ton of money at this time. While in the heat of the recession, you might want to allocate to the crypto, especially Bitcoin. The reality is that Bitcoin eventually comes out on the other side of a recession very strong. Take an example of 2020. 2020, Bitcoin was down. By the way, Bitcoin topped out 2017, topped out at 20,000. Went corrected all the way down over 80% to 3,200. And then just in about a year, it did a 23x. So you might want to, but please remember that investment into crypto, especially, you don't go into those tiny meme coins, please, because those guys will die. Those guys can't even survive a recession. I'm talking about Bitcoin because of the institutional adoption for Bitcoin. Bitcoin is now adopted by core institutions. It's now adopted by, there are ETFs. There are over 100
strong
countries, 100 companies that are actually having Bitcoin on their balance sheets. There are treasury companies. You have a company, even the Harvard. You have sovereigns like the UAE that have invested into Bitcoin ETF. So, I mean, Bitcoin ETF is by far the best performing ETF for BlackRock. So that is some level of adoption that I don't believe Bitcoin will disappear in a recession. So you might want to allocate to Bitcoin. Maybe Ethereum. My thought about Ethereum is that Ethereum, if the future, Larry Fink, the CEO of BlackRock, has always said that the future of everything is tokenization. So you have tokenization of bonds, tokenization of
stocks.
equities, stocks, you name it. If that is the case, I believe that the biggest, the most decentralized, the most neutral rail upon which that would go. Already, you already have stable coins that run on a decentralized system. Ethereum being the big, Ethereum has about over 70% of a stable coin run on Ethereum. So if you believe that the future is of everything, the future of stocks, the future of equities, the future of bonds,
tokenization,
future of real world assets is tokenization, then you want to invest in a platform, in a rail, in a technology that would literally hold that. And that for me is DeFi, specifically Ethereum. So I would say exposure to Ethereum, some other names like Solana, like Sui, maybe, but I can actually like say with some level of certainty that Ethereum, that Bitcoin being when you talk about the digital gold, Ethereum being the behemoth when it comes to smart contracts, and the decentralized finance would be a good name to allocate to if a recession shows up, because I know that after the recession there will be a good rally. So we have mentioned some of the names that you might be looking at. Like I said, there are other names that you could be looking at. We just mentioned industry and some of the names I'm personally looking at. You might want to also look at a few other names. I've been very focused on the US market, specifically because this is actually something that if you're looking at a global recession, it is something that would affect everybody, including the US. So in Nigeria, like I also mentioned some oil companies, I mentioned Seplat. There you have energy beverages. We had mentioned
Coca-Cola.
We've mentioned Guinness in Nigeria. We had mentioned a few names that you might, if you look at our previous video, you would see some of the names that we mentioned that we believe will do well this year.
Dangote Sugar.
So Dangote Sugar falls into staples. Even if we have a recession, are you going to drink tea without sugar?
Dangote salt?
No, you cannot. Dangote refinery is not in the market yet. If it comes to the market, maybe it will definitely benefit.
No, even MTN will do very well. Even if there's recession, you're still going to you'll be online.
You will rather not pay your way. So MTN will benefit before, and not just MTN, telecom companies will benefit because
and the rest of it.
Instead of having to travel, yes, you might want to
make calls,
video calls, and all of that. Set up meetings.
Those are stuff that we do well
and all
during
of those. So those will do well. So, but for me, most especially consumer staples.
Will banks do
and
well?
Then, but I think I should also mention stocks that you should avoid. Number one, please, high growth. In a recession, avoid high growth. Because if the Fed slams the brakes on easing and starts reversing course, meaning start tightening and start increasing, lowering the size of their balance sheet, tech stocks would suffer. Already, the Mark 7 is down over 15%. From its high. So you want
and tech stocks requires infrastructure movements.
Tech stock requires infrastructure movement, but most importantly, tech stocks are kind of discretionary. Look at Apple, for example, a discretionary product. Tech companies will begin to have a lot of inventories because people, when you lay off people, look at like Microsoft, for instance. Microsoft thrives because people buy software for their employees. In an environment where companies are laying off people,
they won't buy.
So mean that volume reduces. That means less money for these tech stocks. So avoid tech stocks. The other one you want to avoid is, please avoid airline companies, airline and travel, because people would struggle, would be trying to survive. Travel will be the least thing on their minds. Also avoid consumer discretionaries. Consumer discretionaries, please avoid them, because these are something that people can do without. Restaurants, for instance, people will begin to cook more. So outing, restaurants, stocks, you have tourism stocks, all of those discretionaries.
Saying on that Dubai is affected, people will hardly travel.
Dubai is affected, okay. So you have travel, airlines, and all of that. So would really suffer. So you want to avoid those three sectors specifically. Let me also mention the likes of Procter and Gamble, P&G. These are known defensives. I had mentioned Johnson and Johnson. You also want to consider that. I had mentioned Coca-Cola. You also want to consider that.
And Guinness for Nigerians.
And Guinness for Nigeria. I've also mentioned for healthcare. I did not mention. Did I mention United Health?
No.
I'm also looking at United. It was beaten down recently, but I think it's come back up. But in the event of a recession, United Health would perform very
I think in our next episode we should actually discuss how to invest in American stocks from any part of the world. I feel most people will not be able to follow. If we don't tell, okay, this is how you can actually invest in an American stock. These are the platforms you can actually use so they can follow whatever we are seeing on this channel.
And it's important that you, at this point, it's not just American stocks. I'm also looking at Chinese stocks. I'm looking at Asian stocks.
Okay.
I'm looking at we've seen the broadening. We've seen how foreign stocks are outperforming US stocks. So at first we were very concentrated.
And it's very easier to invest from any part of the world.
Yes, you can invest in it.
Any part of
there
the
are
world.
tools, there are platforms that allow you to do that.
Invest in any part of the world.
So you don't want to limit yourself
to just Nigerian
stock
or the African stock.
So you can actually decide to look at other markets.
I think our next episode would now be how to invest
European
in anywhere from any part of the world, usually American stocks. No problem. Thank you for coming. And I think we should actually draw the curtain at this point. But before we go, as usual, we'll allow you to give your last snippet to what we are seeing in the market. Either you want to give us hope or you want to tell us what we should expect.
Like I said before, and I'm going to say it again, at this point, with the conflicts we have in the Middle East, the market is very volatile. It's extremely volatile. If you are a trader, manage your risk. You can't afford to enter a trade without stop losses. In fact, because during volatile periods, liquidity is very thin. So sometimes you might even suffer some very serious slippage. So you want to, not just that you are managing your stock, you want to even what you have in your trading account should be something you can literally afford to lose. You can put some of your trading capital in your back office, so that in the event there is a slippage, your broker will stop you out before you register more losses. So you want to be very careful with your stop loss and manage your risk as much as you can. Number two, you want to ensure that any position that you're entering, you don't risk more than, in fact at this time I say more than 0.5% of your capital. The golden rule is you can't do more than 1%. But because you might experience slippage at times like this, you want to do 0.5 to 0.8%. So in the event that you suffer some slippage, it can actually you won't exceed 1% of your account. It's important that you survive this extremely volatile period. For traders that know what they are doing, this is a gold mine. This is a golden opportunity to make as much as you can. But even for traders that are very experienced, you have to be wary of possibility of slippages. A lot of things are coming. A lot of economic data will be coming in the next couple of days. In the next few days, we are still expecting the PCE. A number of economic data will show up, and so you know what the effect that has on the charts. So you have to be very, very careful. You have to don't just follow technicals. I mean, technicals do a good job, but at this point, a lot of things are driven by fundamentals. So follow your fundamentals, look at what is happening, and make your decision appropriately. Risk the amount you can afford to lose.
Because we are in uncertainty, anything can happen in the market.
Anything can happen.
All right, that's a very nice point to drop to this conversation. Thank you very much for coming. Now, on that note, we'll come to the end of today's episode of Clockwise. And please do not forget to like and subscribe. Also, put on the notification bell on this channel because we bring amazing content. And also, do not forget that the illiterate of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence. I'll see you again.